So as discussed, we are going to be having portfolio theory today. Portfolio is a very interesting and then practical topic in financial management. All right. In the class today, we are going to dissect, I will introduce you to portfolio theory. We'll talk about modern portfolio theory. We are going to discuss um, portfolio risk and the types of risk. We are going to talk about portfolio diversification. After that, we'll discuss the risk return trade-off. Then we will talk about uh, how to estimate portfolio risk, return, correlation coefficient, and covariance, okay, between or among securities. There are other scope of portfolio theory, which we are not going to talk about. I will introduce you to it, so just read them through. For example, examiner can ask you to explain capital allocation line, capital market line, or security market line, indifference curve. So you need to know all of this. This is purely theoretical and also very interesting. All right. But however, let's start with the introduction to portfolio theory. Therefore, what do you understand by portfolio? Portfolio represents the collection of several investment instruments, including bonds, shares, and other similar securities. Okay, the collection of several investment instruments, including bonds, shares, and other similar securities. That is what portfolio is all about. There is difference between portfolio and portfolio management, right? There is difference between portfolio and portfolio management. The portfolio management is the art. When I say art, A-R-T, the art of building, all right? The art of building and managing several investment instruments that is consistent with the long-term goals and risk tolerance of investors. Okay, that is what portfolio management is all about. The art of building and managing several investment instruments that is consistent with the long-term goals and risk appetite or risk tolerance of investor. That is portfolio management. For example, you as an investor or you as an individual, let's say you have a surplus fund, you have an amount of money somewhere like, let's say 1 million naira. You're not looking at, okay, this 1 million naira, maybe you have listened to news, investment news or business news, or you've heard from somebody that instead of keeping your money in the bank, in your bank account, why don't you just invest this money on a particular security? So you head down, you are interested. Therefore, you need to approach a portfolio manager that will help you to invest your money on your behalf. Before the portfolio manager will commit your limited scarce financial resources into any investment, the portfolio manager will need to assess your financial goal. What goal do you want to achieve? What is your risk appetite? The financial goal of every individual investor differ depending on the nature, characteristics, and the experience of individual investor. All right. For example, you as a working class, your financial goal is different, maybe different from the financial goal of a retiree, right? Because as a working class, you still have opportunity to to work for additional years before you retire, right? Your goal may be that, okay, you want to erect or you want to build your own owner-occupier building, right? So that may be your finance. Maybe in the next 5 years, you want to save money or you want to invest your money that will be that will accumulate so that in the next 5 years you have sufficient money to go and build your own house. That may be your financial goal. Your financial goal may be that, okay, I want to purchase SUV vehicles. So let's say, for example, for 20 million naira or 10 million naira, whatever the amount. All right, but you don't have the immediate amount now. What you have now is 1 million naira. All right, let me invest this 1 million naira so that I can double it at a particular period in the future, and then I will use the money to purchase my SUV vehicle. All right. Your goal may be that as a married man or as a married woman, you want to pay for your children's school fees. You have a specific university that you want your children to attend when they grow up. Therefore, you are now investing that money so that in the future, once your children has reached that particular age for them to gain admission, you can withdraw your investment for the purpose of funding their education. So that is for a working class. But a retiree, the financial goal of a retiree may be that, okay, I want to have a stream source of income so that once I retire, I will have something to take care of my financial needs. All right. So because as a retiree, at that point, you have reached a peak, right? So all you need to do is to just take care of yourself. Maybe you want to go on vacation, right? So once I retire, I would like to visit Mauritius. I would like to visit Ghana. I would like to visit America or anywhere in the world. Or you want to tour around the world. That may be your financial goal. Whatever is your goal. What we are trying to say here is that the financial goal of every individual investor differ, and as a company or as a portfolio manager, I need to assess your financial goal. I will now compare your financial goal with your risk appetite. The risk appetite is the level of risk that an individual investor will be ready and willing to accept. All right. And then there are different nature of individual. For some of you that did performance management, you will recall a few days ago, we talked about it, whereby I mentioned to you the attitude of decision maker or investor. We have risk aggressive investor, we have risk averse, we also have a risk neutral. All right. So as your risk appetite will depend on the nature and the characteristics of individual investor. So this is what we are saying. All right. So that is basically the introduction to portfolio theory. Now, what do you understand by modern portfolio theory? The modern portfolio theory is a theory that is based on how a risk-averse investor can construct portfolio to maximize expected return at a given level of risk. Okay, I repeat, examiner can ask you to explain modern portfolio theory. So you need to know, all right? I said that modern portfolio theory is a theory that is based on how a risk-averse investor can construct portfolio in order to maximize, okay, expected return at a given level of risk. The theory stipulate that, okay, the theory stipulate that investors should not only hold portfolio, but should also be concerned about how individual securities in the portfolio are related to one another. All right. In a basket of investments, you can have, for example, you can have bonds, you can have shares, you can have commodity like gold, you can have real estate, you can have exchange traded fund, mutual funds. So you can have several investments in the portfolio. So as a risk averse investor, remember, a risk averse is an individual investor that do not like risk. All right. So As a risk-averse investor, you are not only focusing on the portfolio, right? Your focus is not just on the portfolio that you have gathered, right? So but you should be more concerned about the relationship, how the securities in the portfolio relate to one another. The bonds, the investment in bonds, shares, commodity, real estate, exchange traded funds. Is there any likelihood of relationship between or among them? So you need to be concerned with that, because that will determine the relationship between the securities in the portfolio would depend. I mean, we have far-reaching effects on the performance of your investment at the end of the day. All right, because gyration can erode the invest can erode investment, and that's why it is important to take into consideration to give high consideration to how securities in the portfolio relate to one another. Now, the modern portfolio theory is premised on the assumption that investors are rational, okay? Investors are rational and do not like risk. When you say rational investor is an individual that have understanding of how investment works. You know the markets, how the market will react. You know you have the information. You have the information about the investment and all of that. So you know you are educated about the investment that you want to undertake, right? So the modern portfolio theory is an assumption, okay? It is based on the assumption that a rational investor do not like risk, okay? It's based on the fact that a rational investor do not like risk, which means that given an investor a high level of risk, the individual investor will also expect a high level of return, which is consistent with what everybody is aware of, that the higher the return, the higher the risk, and vice versa. So, but a rational investor is saying, given a rational investor a high level of return, he will expect the same level of risk. And where two or more securities have the same level of return, such individual will select the security with a lower risk, right? Security A and B, they have the same level of return, but different level of risk. Therefore, since they have the same level of return but different level of risk, such individual will select any of the two securities, either A or B, that has a lower risk. This is this is modern portfolio theory. This is modern portfolio theory. And this position can be diagrammatized using the efficient frontier. Let me show you how, because once in a question, if the examiner is asking you to explain modern portfolio theory, these are the things we are going to talk about. And if you want to impress the examiner, you need to draw your graph. You need to draw up your efficient frontier graph to explain the theory that you have just talked about. Okay, let me see. Let me see. We check the recording to be sure that we're on track. All right. So like I was explaining the modern portfolio theory, we state that the theory stipulates that investors or a rational investor do not like risk. All right. Investors are rational and then they do not like risk. That is, given an investor a high level of risk, he or she will expect the same level of return. And where two or more securities have the same level of return, he or she will select security with a lower risk. And this can be diagrammatized using efficient frontier graph. All right. So in the efficient frontier, we have this is how efficient frontiers look like. Let me draw for you. So after you have explained the theory, examiner can ask you to explain modern portfolio theory. So after you have done all those explanations I've given to you, you need to diagrammatize your point so that you want to impress the examiner that you know what you are doing, right? So this graph, we have both the risk and return axis. Okay, let's say this is 0.0, return is on the horizontal axis, while the risk as measured by standard deviation is on the vertical axis. So here is standard deviation. All right, let me adjust this one a little bit. Let me push it up. Return. All right. So for the return, I have return level 1. I also have return level 2, right? So I have standard deviation. I have risk level 1 and then risk level 2. So this is D1, standard deviation 2. All right. So I can join it. I can say this is, let me join this one to come down here. Let me remove this one. Okay, so do it this way. All right. But another one will come like this. Okay, so we have D1, D2, R1, then R2. Now, the risk and return intercepted at this point. Okay, they intercepted at this point. Risk and return intercepted at this point, and they also intercepted at this point. All right, those are the 3 points of intersection. You are going to draw a line from the origin. 0 is the origin. You draw a line from the origin that will pass through in between of the graph. So the line will come like this. That line is called efficient frontier. Okay, then you need to label your the points. You need to label each point of intersection between the risk and return. Let's say this is point A, here is point B, and then here is point C. Now, you need to explain point A, B, and C on this graph. So this is what you are going to be saying in case you want to, examiner is asking you to explain efficient frontier or to explain modern portfolio theory, and you want to demonstrate how much you know about the modern portfolio theory. Now, you will notice that A and B fall on the same line R1. Let's do this because of time. From the graph above, let me push it to the back. From the graph above, all right, let me use colon. From the graph above, 1, securities A and B fall on the same level of return R1. So I will say securities A and B lie on the same level of return R1, but at different level of risk, but at different level of risk. Level of risk D1 and D2. So this is what I'm trying to say. When you look at this line for security A and B, the two of them, they are on the same level of return R1, but the risk associated with A and B are different. A has risk level D1, whereas B has risk level D2. Therefore, point 2 that you need to make is that between security A and B, let me ask you, between security A and B, based on my initial explanation on the modern portfolio theory, security A and B, which one will you select if you are to make a choice between A and B? If you know it, raise your hand. Between security A and B, if you are to make a choice, which one will you choose? Yes, Abdulateef, go ahead.
I will choose A, sir.
Why?
Because the level of risk is lesser to that of the.
Is that all?
I don't want to involve in more risk, and I want my returns in full. That's it.
All right. So you are correct that security A should be selected. Yes, Ogechi, go ahead.
Okay, I just wanted to ask that as much as the risk for A is lower than B, the returns are on the same level. So that's
You are
another
correct.
question.
That's what I want to hear. That's what I want to hear because you have to compare the risk and return. Now, when you look at security A and B, because they have the same level of return but different level of risk, therefore security A with a lower level of risk should be selected. So you then say security A with a lower level of risk relative to security B. Relative to security B is preferred. Okay, so we are done with that explanation. Also, when you look at security B and C, when you look at security B and C, you will notice that B and C lie on the same level of risk, D2, but different level of return. Therefore, security C with a higher return, since the two of them, since B and C have the same level of risk, but different level of return, therefore, security C with a higher return is preferred over security B. So you put it down. Number 3 points that we need to make. Securities B and C lie on the same level of risk D2, but at different level of return R1 and R2. Okay. Point 4. Securities C with a higher level of return is preferred over security B. Okay, so that explains the relationship between security B and C. Now, further, you will notice from this graph that security A and C are preferred over security B, and then security A and C lie on the efficient frontier. Therefore, I will then come here, number 5 point, the 5th point. Securities, because what you are doing here is you are just explaining your graph. That's what you are trying to say, you are trying to do here. All right, so security A and C are preferred over security B, and they lie on the efficient frontier. All right. Therefore, and they lie on the efficient frontier. Therefore, security A and B possess a stochastic dominance. All right. Number 6. Therefore, security, let me put therefore. Therefore, securities A and C possess a stochastic dominance over security B. Over security B. All right. So that is for that. Then point number 7 that we need to make. The choice is now between security A and C. Or let's shorten whatever the point that we want to make. Now you can see point A and security A and B. Sorry, because security A and C are preferred over security B. So the choice between security A and C will depend on the nature and then the risk tolerance and characteristics of individual investor. So let's shorten our points. So I can then come here. The choice between securities A and C will depend on the nature, characteristics, and risk tolerance of individual investor. Let's make the last point, number 8. So when you look at, let's go back to our graph. When you look at security A, you will notice that security A has a lower risk and a lower return. Therefore, a risk-averse investor, a risk-averse investor is an individual that do not like risk, and we always select security with a lower risk and lower return. So a risk-averse investor will prefer security A, but security C will be preferred by a risk taker, because a risk-aggressive investor will want to go for the best, the highest of the highest, not minding the level of, you can see, the higher the risk, the higher the return. Security C has a higher risk and also a higher return. Therefore, the final point that we need to make, which is, I would then say, a risk-averse investor will select security A with a lower risk and a lower return, whereas a risk-aggressive or a risk-happy investor, a risk-aggressive investor will choose security C with a higher risk and higher return, with higher risk and return. All right. So, like I said, in this your final analysis, your selection of A or C will depend on the nature of the individual investor, because our risk appetite differ. If I like risk, if I'm looking for the highest return, then I have to select the security with the highest return and then the same level of risk. If I don't like risk, like a risk averse, then I will select the security with a lower return and lower risk. So the two of them are good. Both A and C are good. They are desirable and they are desirable and achievable. But the choice between the two will depend on the nature of the individual investor. So this is the explanation of modern portfolio theory. Okay, so without switching pages, let's talk about risk return trade-off. Okay, so you have material, you can open to your material over there. Let's talk about risk. We are done with modern portfolio theory. So let's talk about risk return trade-off. Again, this is an examinable area. So you need to know, what do you mean by risk return trade-off? Based on our explanation, the risk return trade-off is the relationship that exists between risk and return. And then is the positive, let me put it down. This represents the positive relationship that exists between expected return and risk. All right. So in an efficient market, when you talk about positive relationship, which is consistent with what we know generally, that the higher the risk, the higher the return, and then vice versa. That's a positive relationship. So what we are now saying here is that, and that's why you see that, let me go back to the graph to buttress my point. When you see this graph, you see that from point 0 is moving up, is moving higher. That's a positive relationship. So the higher the risk, the higher the return. The lower the risk, the lower the return. So that's a positive relationship we are talking about. All right. So the risk-return trade-off is that positive relationship that exists between risk and return. And in an efficient market, it is not possible it's not possible to achieve a higher return without taking the same level of risk. Let me put it down for you. In an efficient market, it is not possible to achieve a higher return without accepting a higher risk. Okay, so this is what is known as risk-return trade-off. Then after this, we are getting there little by little. Let's talk about portfolio risk. Let's talk about portfolio risk. What do you mean by portfolio risk? What is portfolio risk? The portfolio risk, this is an event that the anticipated or the expected return may be different from the actual return. You know, when you want to carry out investments, when you want to invest in any opportunity available, right? Before you commit your financial resources, you would have had your own targeted rate of return on your investment. Maybe you want to earn 10% return on your investment, maybe 20% or 30%. But at the end of the investment, the actual return may be different from what you anticipate to earn. So this is a risk because market events or market condition can impair the ability can impair your investments, can impair your investment performance. So as a result, what you intended to achieve may not be achieved at the end of the day. It may be different from what you anticipated to earn at the end of the day. So this is a risk. Not only that, in addition to this, a risk is a chance that all the investment or part thereof may be eroded. Let me put it down. It is also a chance that a part of investments, a part or all of the investments, all of the original investments may be eroded. Okay, that's a risk. You can imagine there are some investors in 2008 during the economic meltdown, when the market crashed, when the stock market crashed in 2008. Almost all the investors lost money. In fact, some people committed suicide as a result of that event. All right? And that's what we are saying here. It's a risk. You have committed money in an investment, and at the end of the day, due to market condition, the entire investment is gone. You can imagine the level, what the impact will be on the investor. All right. So that's a risk. Part of your investment may be impaired. All right. So what you anticipated to achieve or to earn at the end of your investment period may be different from what you actually achieve. That's a risk. Now, risk is measured by standard deviation. It should be noted. Let me be fast. It should be noted that risk is measured by standard deviation. And the higher the risk, the higher the standard deviation, the higher the standard deviation, the higher the risk of the portfolio. Okay. So that is what risk is all about. What are the types of risk? There are majorly two types of risk, right? One, we have systematic risk. Two, we have unsystematic. This is examinable. So you need to know. What do you mean by systematic risk? Systematic risk this is also known as let me see the approach so that we can complete this. This is also known as all right. This is also known as general market imposed imposed beta non-diversifiable unavoidable risk. Let me stop it there. It is a kind of risk. Systematic risk is a kind of risk. That investor will like to pay to avoid, which is not possible. It is a risk. It is a type of risk that affects every company in the economy. So that is systematic risk. Any risk that affects every company or businesses or industry in an economy, it is known as systematic risk. And such risk is general. When you say general, general means everybody. That risk will affect everybody in the economy. All right. It is market imposed. It's beyond the control of any individual company. Nobody, not even government, can control systematic risk. and it is not diversifiable, right? It is unavoidable. Everybody must bear systematic risk. What are the examples of systematic risk? What are the causes? Okay, what are the reasons or causes of systematic risk? So like I said, this is an examinable area at this level, so you must know it. Number one, pandemic. When there is pandemic in a country, for example, COVID-19, you remember during COVID-19, the entire world was under lockdown. Businesses could not operate for several months. This is the kind of risk we are talking about. Everybody bear the brunt of pandemic COVID-19 when it came. All right. So that's the kind of risk we are talking about. It affects everybody in an economy. Two, changes in interest rates. Okay. So when interest rates increases, everybody will bear the impact in the economy because investors will need to borrow at a higher rate. Once the Apex Bank increase their NPR, of course, that means bank will also increase their lending rates. So when that happens, investor will not be able to borrow as much as possible because of the cost of borrowing. Therefore, once those investors that are able to borrow at the required rates, that means they need to push the burden on the final consumer. Except if you don't buy in the economy, everybody will bear the impact of that particular event. So whenever there's increase in interest rates in the market, certainly everybody will bear because all of us will buy, whether you are in the rural area or you live in the urban, certainly you buy things in the market, and then in that case, you are going to be affected. All right. Then three, inflation. When there is inflation, the purchasing power of money will fall. Everybody will bear it. You go to the market and you buy clothes, you buy food, you enter transport to and fro to wherever you are going. Inflation will affect everything because once there's inflation, the retailers or seller, everybody will incorporate that in the price of their goods, even the price on services, everything will go up. All right. Not only that, number four, another reasons for systematic risk or causes of systematic risk is economic meltdown. Okay, when there is economic meltdown, every company in the economy will bear it. Like I mentioned the other time, the 2008, the economic market crisis, whereby investors lost money. All right, this is a type of it. And other one, there could be political instability. Maybe there is a war in a country. When there is a war in a country, certainly there will be no peace. And when there is no peace, there will be no investment. Everybody will bear the brunt. Okay, you can imagine what is happening in Gaza. There's no peace, no rest of mind. All right, in such an environment, there is hunger, there is famine. Okay, so in such an environment, there is no kind of business that you can do because there is an unstable political environment, geopolitical crisis. So these are some of the examples of systematic risk. Let's talk about unsystematic. Okay. So the unsystematic risk, this is a kind of risk. This is a kind of risk that is peculiar to a particular company or industry. It is also known as unique, non-market imposed, alpha, diversifiable, and avoidable risk. Okay, so the unsystematic risk is a unique risk that is peculiar, is a kind of risk that is peculiar to a particular company in an economy or to a particular industry. It's not general, it doesn't affect anybody apart from the industry or the particular company. You recall recently, last week, Saturday, when we had our class, October 4th, when we had our class, we have to merge the online students, the online student with the VI student. Why? Because the VI student could not access the location center. Why? Because Lagos State government are having an event on that axis, on the Lekki VI axis, because they're having water game. I can't remember the name of the events, motor race on the water, something like that. So there was a restriction of movements along the Ozumba Mbadiwe road. Therefore, we could not enter the VI location. So you can see every other tuition center that are on mainland are not affected with that particular restriction. In fact, some tuition centers elsewhere, all right, be it even in on the mainland, like I said, are not affected with that restriction because the restriction is mainly on the island. So you can see equity professional could not access, and that's a risk to equity professional. And that's why we have to improvise, say, okay, instead of not having lecture at all, why don't we just do match the VI student with the online student so that day will not be lost for the VI classroom student. All right. So that's because that event is peculiar to equity professional. Even with equity protection professional, because we have other center in Isolo, our center in Isolo was not affected because we went there on that day physically to lecture. All right. So this is any risk that affects any event that affects a particular industry or a particular company are what is called unsystematic risk. Not only that, recently you will notice last year, the Apex Bank, the CBN, rolled out the recapitalization exercise in the banking industry. Not all industries are affected with that change. All right, only the banking industry are affected. All right, so every other industry in the economy are not affected. So that is also known as unsystematic risk. So what are the examples or causes of unsystematic risk? Reasons, causes, or examples of unsystematic. Okay. One is regulatory change. We have to move faster. Regulatory change, like what is happening in the banking industry. All right, so it affects only the banks, insurance, every other sector, agriculture, agricultural sector, all those ones are not impacted. Then we have management change. When there's management change, that can affect performance of a company. Then 3, we can have product recall. When there's product recall, this will affect a particular company that made the recall. You remember some years back, Samsung have to withdraw a model of their Samsung Galaxy or whatever because the phone was generating it. As a result, that particular recall will result to financial losses because the company has already spent money to produce the phone. Now you are recalling it, you are calling it back. When you do that, that will be a loss. So every other company in the industry like Apple, like Nokia, they are not affected with that product recall. It's only Samsung that is affected. That is one of the that's what we are talking about as per the unsystematic risk. Then you can also talk about limited you can talk about limited product range, okay? Limited product range or a bad location for a company. If a company is not strategically located, it can affect the performance of the company in the economy of the investments. All right. So those are the some examples of unsystematic risk. Now, before we begin to talk about how to estimate portfolio risk, portfolio return, correlation coefficient, and covariance, let's talk about portfolio diversification briefly. Portfolio diversification. All right. Okay. Maybe I should make portfolio diversification the last point. Yeah. Let's make portfolio diversification the last point so that quickly, let me just show you how to estimate. So calculating portfolio risk, return, correlation coefficients, and covariance. Okay. So if you want to estimate portfolio risk, how do you do it? What are the formula? Let's first thing first. Let me show you how to calculate the risk of individual security in a portfolio. Risk of individual security. We have done this under risk and uncertainty. So, as measured by standard deviation. So the risk of individual security is computed as square root of variance. All right, so this is summation of probability of X minus X bar squared. So anytime you want to estimate the risk of individual security in a portfolio, so this is the formula that you are supposed to use. Then, how do you then estimate the risk of portfolio or portfolio risk? Right? So portfolio risk can be computed in 2 different forms. You can either use tabular method or you use algebraic method. Whichever one you do, you are going to get the same answer. All right, we are going to try the 2 when we have illustration. But first thing first, let me give you the formula. Now, to calculate the risk of the portfolio, it will be square root of the proportion invested on security, let's say where you have two asset portfolio for a two assets portfolio. That is, you only have two securities in the portfolio. All right, so for two asset portfolio probability, the risk of the portfolio will be determined by taking the proportion of, let's say we have security X and Y. So you take the proportion invested on security X, you square it, you multiply with the variance, of security X. You keep it on one side, plus the proportion invested on security Y. You square it, multiply by variance of security Y, plus 2, because we have two asset portfolio, that is, we have only two securities in the portfolio, plus 2 multiplied by the proportion invested on security X multiplied by standard deviation of security X multiplied by proportion invested on security Y multiplied by standard deviation of security Y. All of that multiplied by the correlation coefficient between security X and Y. Okay, so this is the formula for calculating the risk of the portfolio. All right, I will explain the variables later on, but for now, let's move on. Now, let's talk about, let me show you the formula for calculating portfolio return. Then, let me underline this. Okay, and this. So let's talk about portfolio return and return of individual security. For return of individual security in a portfolio, you are supposed to calculate expected value. Again, we did this under risk and uncertainty. So expected return of any individual security is computed as summation of probability of X. That is, just multiply probability with the return. Okay? Then, for return of the portfolio, RP, the return of the portfolio, RP, will be computed as the proportion invested on security X multiplied by the expected return on security X plus proportion invested on security Y multiplied by expected return on security Y. So this will give you the return of the portfolio. Finally, we talk about correlation coefficients. Correlation coefficients, denoted as R. The correlation coefficients measure the relationship that exists between securities in a portfolio. Let me write it down for you. This measures the relationship that exists between securities in the portfolio. All right. So when you want to measure the relation, when you want to measure how securities in a portfolio relate to one another, then you need to estimate correlation coefficient. And the correlation coefficient, which is denoted as R, is computed as covariance between security X and Y, where you have two assets portfolio, all right, divided by standard deviation of security X multiplied by standard deviation of security Y. This is the formula for determining the correlation coefficient. On the final note, each formula, how do you compute? Before you can calculate the correlation coefficient, you need to first of all determine the covariance between the securities in the portfolio. All right, so what do you mean by covariance? How do you then estimate the covariance? So this measures, or this represents the linear relationship between variables. So when you want to measure the linear relationship between securities in a portfolio, then you need to determine the covariance. So the covariance between security X and Y will then be computed as summation of probability multiplied by X minus X bar multiplied by Y minus Y bar. Okay, so this will give you the covariance between securities in the portfolio. So let's define the variables where we started with, let me check. We started with D. Yeah, D is standard deviation. Okay. Where D equal to standard deviation. P equal to probability. Probability X equal to the return on security X. Then X bar is the expected return on security X. The Y bar, expected return on security Y. Then we have W of X. WX equal to proportion invested in security X. WY, proportion invested in security Y. Then we have R, which is equal to correlation coefficients. Okay, then we have COV, X and Y, which is covariance between securities X and Y. So these are some of the definition of, these are some of the, yeah, dy, dx, standard deviation of x. Let me see which one again. I think that's okay. That's okay. Now, these are the relevant formulas that you are going to need to estimate portfolio risk, portfolio return, correlation coefficients, and coefficient of variation. Now, bear in mind there are three types of correlation coefficients. There are three types of correlation. We have positive correlation. Okay, let me put it down. Types of correlation. So there are three types of correlation. One is positive correlation. Two, we have negative correlation. Three, we have zero correlation. When the securities in the portfolio are affected with the same events, that means they have positive relationship. That is a positive correlation, all right? But if the securities in this portfolio are affected with different events, all right, such that if a performance of a particular security go up, the performance of other security may go down, all right? So they are in opposite direction, all right? So when the events that affect security in a portfolio are in opposite direction, that means they have a negative relationship, okay? Now, zero correlation means that there is no relationship between the securities in the portfolio, all right? So those are the three types of portfolio. Finally, now, when you are calculating notes, before we go to portfolio diversification, notes, Rose Simon, I'm coming for you, just hold on. Notes, or when the probability, when probabilities of securities are different, it means there's no relationship. There is no relationship between the securities in the portfolio. Now, what we are saying is that if in a question you are given different probability for each security, let's say we have security X, you also have security Y. The probability of security X is 0.3, 0.4, then 0.3. Probability of security Y is 0.2, 0.3, then 0.5. As you can see, both security X and Y have a different probability. That means there is no relationship. They are independent of their own. No relationship between the two securities. So when this happens, it means that your R is equal to 0. When you are calculating the risk of the portfolio, where you have the correlation coefficients, okay, where you have the correlation coefficient, here, this R will be equal to 0. When the probability of the two securities are different, it means that there is no relationship between the two securities. That is, R is equal to 0. But if in a question you are given the same probability for the two securities, it means there is a relationship and you need to go and compute your correlation coefficient. So that is what I want to point out to you. That is an exam tip, all right? It's an exam tip. No, examiner will not tell you that there is no relationship. So it is implied in the question. How will you know that there is no relationship? Once you are given different probability for the two securities, it means that your R is equal to 0. Okay, but if you are given the same probability, when you are given the same probability, then it means that there is a relationship between the two security, and therefore you need to go and compute the correlation coefficient. Now, Rose Simon, talk to me quickly.
Sir, I want to ask, the format in this particular topic we are discussing, will it be stated at the back of the question paper? Because the thing is plenty.
Which format? Format or formula?
Formula. Will it be
Whether it will be given to you on the day of your exam?
at the back of the question paper?
Rose Simon, you are looking for easy routes. No. It will not be given to you. You have to master it. You know, when you look at the back of your question paper, examiner will give to you some formulas. In fact, in most cases, those formulas that will be given to you may not be relevant to the calculation. All right. So it will not be given to you at all. Right? Diversification. So do your best to master the formulas. All right. Do your best to master the formulas. So final area that we are going to touch base will be the portfolio diversification. You know, like when I started with the definition of portfolio, I said that portfolio represents the collection of several investment instruments, okay? Collection of several investment instruments like bonds, shares, stocks, or other similar instruments. Okay, that's a portfolio. For example, in a basket of investments, you can have bond. Okay, you can have real estate. Right, in the basket, you can have shares. You can have exchange traded fund. You can have mutual fund. Okay, you can have investment in commodity.
Commercial paper.
You can have investment in commodities. So all these investments, what we are saying is that as an individual investor, right? Let's say, for example, you have 1 million naira and you want to put that 1 million naira in an investment, right? And instead of you to invest the 1 million naira in shares of a particular company, portfolio diversification is teaching us not to put all our eggs in one basket. That is, you need to diversify your investment so that if market condition is not favorable, all your entire investment will not be lost. Say, for example, that 1 million naira that you want to invest, you can allocate it among competing investments. You can put like 30%, you can invest 30% on bonds, okay? You can invest like 20% on shares. You can invest like 5% on exchange traded funds. You can invest additional 5% on mutual funds. You can give 15% to real estate. So you can give another percentage investment to commodity, whatever the investment that you want to carry out, right? So this is what we mean by portfolio diversification, which is a strategy designed to mitigate the risk arising from market fluctuation, right? Because it is expected that each investment or each security will not react to market gyration in similar way. You know, there will be volatility, and there will be market volatility. The price will go up, will fall down, and it will be fluctuating. So when that happens, that can affect your investment. So what we are now saying is that as portfolio diversification, that you should not put your 100% of investment on a particular security, on only one security, because once you put your eggs in one basket, when that basket spoiled, that means your investment, everything about your investment will be gone. So it's a strategy that is designed to help a rational investor to avoid a disastrous or a catastrophic financial outcome, right? You know, when you invest your money, 1 million naira, and the market condition erode your entire investment, that's a catastrophic end of your investment, and you want to avoid that. That's why you are diversifying your investment. So portfolio diversification teaches a rational investor not to put all your eggs in one basket, right? Don't put all your eggs. That's the primary focus of portfolio diversification. It's a strategy to minimize portfolio risk. All right. So you don't put all your eggs in one basket. That is because when you spread your even if you are investing 20%, this 20% on shares, if you are investing that percentage on shares, it is not sufficient to just put the entire 20% on a particular company's share. You also need to diversify that investment in shares across several industries. You can invest maybe out of this 20%, you can invest like 30% to buy a particular company's share in the bank, in the banking industry. You can put like 5% in insurance to buy a share of a company, of an insurance company. All right. You can use another percentage to purchase shares in a manufacturing company. You can use another percentage to purchase shares in fact, even go to outside Nigeria to have some kind of international diversification. So because you must, as a rational investor, you must develop, you must design a well-diversified portfolio that will enable you to mitigate against to mitigate the risk. All right, this is what is known as a portfolio diversification. For some of you that are doing audits, your lecturer might have talked about the Enron, the case study about Enron's. You know, in 2002, Enron collapsed. All right, Enron is one of the top companies in America, in fact, in the world during his own time. You know, between 1919 and the year 2000 or thereabouts, the company was doing well. Company was paying high dividend to shareholders, and not only that, the market price as at that time was traded. The market price of Enron share was traded at $90 as at up to year 2000. But the unexpected happened in 2002. Before that, 2002, in the early 90s up to year 2000 and 2001, the employees of Enron's, they participated in the retirement savings plan, okay, whereby some of their, instead of them to receive their salary, they put some of their salary in the retirement savings plan of the company. All right. So with the hope that once they retire, then they will begin to have some kind of a return on their investment, so that we have a stream source of income. All right. Some of the employees, they also invested millions of dollars into the company's shares and all into that retirement savings plan. And then the unexpected happened in 2002 when the shares of the company fall flat to zero. And then the company was liquidated, and then the entire shares, everything fall flat to zero. And that was what informed the Sarbanes-Oxley Act of 2002 as a result of that collapse of Enron. So many things, so many issues were the causes, were the reasons why the company collapsed. But that's not the class, that's a class for another day. The audit lecturer would have told you all of this. But what lesson could you learn from the fall of Enron, from the employees and or retirees of ex-retirees and employees of Enron? Because they put all their eggs in one basket. They believe that the performance of the company as at that time will be sufficient for them to take care of their future at retirement. But the reverse was the case. They lost their investments. You can imagine the impact. Somebody you have already retired. Where do you want to start all over again? All your life saving, everything gone just like that. This is what we are talking about. So you have to learn, you have to take a leave from that kind of incident, such that when you have investments, don't put it in one basket. You have to spread your investment. So that's portfolio diversification. We also have three types of diversification. We have horizontal diversification, we have conglomerate diversification, we have a concentric diversification. All of these are in your notes. Please go ahead and read them through. All right, we have about 1 hour so that we can do calculation. Now, examiner can ask you, how do you minimize portfolio risk? This is an examinable area. How to minimize portfolio risk. Okay. How to minimize portfolio risk. To minimize portfolio risk, investors should invest in securities that are negatively correlated. Investors should invest in securities that are negatively correlated or securities with no correlation. That is how you can minimize portfolio risk. You have to invest in securities that are negatively correlated or securities with no correlation. Okay. Additionally, investors should balance share investments across several industries. Like I mentioned the other time, you can have some investments in the financial service like banks, okay, insurance. You can also have investments in the telecommunication, energy, technology, IT or tech company. So by spreading the securities in the portfolio across several sectors, investor can balance the normal fluctuation that this industry may experience, and their impact on the portfolio will be minimized. Not only that, to reduce portfolio risk, investors should target geographical diversification or international diversification. By taking your investment out of the shore of Nigeria, for example, you can invest some money. You can invest some money in other clients. Let me for buy share like from Google, from Microsoft, Nvidia, those kind of a company. When you do that, when you carry out investment international diversification, then that will help you to hedge the portfolio risk, because investing in international markets is also an essential part of a well-diversified portfolio. But one thing you need to understand is that no matter how well diversified is your portfolio, risk can never be eliminated. It can never be eliminated. You can only minimize or reduce the risk. You cannot eliminate it. So this is how to minimize portfolio risk. So you also see it in your notes. Please do well to go through it. All right. So at this point, let's have calculation. Somebody is sending me the charts. Yes, Rose Simon. All right. Is the class recording? Okay. It's not. Rose Simon, the class is not recording. That means we have to start all over, abi? No worry. We are recording it. All right, so let's have calculation. Let me stop sharing this. I just pray. I have two illustrations that we solve for you. Hopefully, let me see. Share. So like I said, you go through your material and read more. Go through your material and read more about what we have discussed so far. They are all in your notes. So read more about portfolio diversification. If you have the Golden Book, if you have the FM Golden Book, you are going to see the story about Aaron. Okay, you see the story about Aaron, right? So all those things that has to do with the indifference curve, the capital allocation line, capital market line, security market line. So just read them through, all right? Go to ICAN study pack. You can see it there. If you see it there, then just form a note on them. They are very straightforward. All right, let's have illustration. I need somebody to read illustration number 2 for us. Okay? Go to page, in your material, go to page 94, illustration number 2. Yes, who is helping us to read? Rose, you want to try?
Yes, sir.
Yeah, go ahead.
You are considering investment in one or both of two securities, X and Y, and you are given the following information as follows. Security X and Y, their possibly return of rate of return and probability of occurrence. You are required to A1. Calculate the expected return for each security separately and for a portfolio comprising 60% of X and 40% of Y, assuming positive correlation between the possible rates of return from the shares comprising the portfolio. B. Calculate the expected risks of each security separately and of the portfolio as defined above. For this purpose, the measure of risk may be taken as the standard deviation of probable variances from the expected rate of return. C. Outline the objectives of portfolio diversification and explain in general terms why the risks on individual securities may differ from that of the portfolio as a whole.
Yeah, thank you, Rose. That is the question. In number A requirement, you are to calculate the expected return of each security separate, that is, you should calculate the return of individual security. And then 2, you calculate the expected return of the portfolio. That's what examiner wants you to do. Then you are to assume a positive relationship between the possible rate of return from the shares comprising the portfolio. Now, one thing you also need to understand is that as far as portfolio is concerned, your return must be expressed in percentage. Please pay attention to this. At all time, when you are given a question under portfolio, your return must be expressed in percentage. If you are given a return in absolute value in Naira, so you need to convert it to percentage. There's a formula that you can use. When we get to the other question, I will show you how to do that. But this question, we don't have we don't have such a thing. The return is given to us in percentage, which is good. All right. So we want to calculate expected return of individual security and also for the portfolio. Now, to do this, let me stop sharing this because of time and move to the working notes. Okay, so solution to illustration 2, page 94. All right. So according to the question, we're not given the name of the company or of the investor, so no worries. Then I will come here. Examiner is asking you, number A, Roman figure 1, you have to calculate the expected return of individual security. So I would then say expected return, calculating expected return of individual security or of security X and Y. X and Y. That's the heading of what we want to do. So to do this, I would then say expected return for security X for security X. The same way we calculated expected return under risk and uncertainty is the same way we are going to do for each year. So to calculate the expected return, you create a column for probability, denoted as P. Then the next column will be for return, which is for X. In this case, we are doing for security X. Then we are going to calculate the expected return, which is probability multiplied by X. Now, because we also need to calculate the risk of individual security, meaning that you need to calculate standard deviation. Therefore, you need to calculate variance first. So I will then expand my table to calculate variance. So I will then say X minus X bar, X minus X bar squared, then probability of X minus X bar squared. So we go back to the question, what are the probability given to us? The probability of security X and Y are different, meaning that there is no relationship between the two security, that is R is equal to 0. So probability of security X is 0.3, 0.4, and then 0.3. Here is 0.30, 0.40, 0.30. Give me the return quickly. Are we together?
There's 30,
Uh-huh.
25,
Uh-huh.
20.
And then 20. So this is expected return on security X. The probability must be equal to 1. So this will be variance. So now to now get the expected return, so you then multiply 30.3, 30% multiplied by 30. That will give us 9.
9.
All right, here is 9.
10.
Then 40% of 25,
10.
10. 30% of 20,
6.
when you add it up, we have 25. So the expected return of security X is 25. Then to get the variance, X minus X bar, X is 30, 30 minus 25 will give us
5.
5. 5 squared will give us 25. 25 multiplied by 0.3, what do you have?
7.5.
7.5. Then 25 minus 25 will give us 0.
0.
20 minus 25 will give us minus 5.
Minus 5.
Minus 5 squared will give us 25. 25 multiplied by probability of 0.3, we have 7.5. So variance of security X is 15. All right. So I will then calculate standard deviation of security X, which is square root of variance. And variance is summation of probability of X minus X bar square. Therefore, square root of 15 is equal to what? What's square root of 15? 15 square root.
3.87. 3.87.
That's 3.87. So that's the risk of security X. Examiner asks us in A that you should calculate expected return and then of the expected return of individual security and of the portfolio. All right, we've only done for security X. So this is more like a working, right? So I would then do for security Y. Do the same thing for security Y. Okay. All right. Probability, then return, then expected return, which is probability multiplied by Y. All right, we have Y minus Y bar, Y minus Y bar square, then probability of Y minus Y bar square. So give me the probability of security Y.
0.2,
Uh-huh.
0.6,
And then
0.2,
0.20. Give me the return.
50,
Uh-huh.
30,
And then
10,
10. So we need to get the expected return. So let's multiply.
10,
10, okay,
8,
18,
2,
and then 2. When you add it up, this will give
that's
us
30,
30.
30.
So expected return on security Y is 30. To now get the variance of security Y, this is of X. So to get the variance of security Y, 50
20,
minus 30 will give us 20. 20
0,
square, this will give
400,
us 400. Multiplied by probability of 0.2,
80,
80. Then 30 minus 30,
0,
0. 10 minus 30 will give us minus 20. Minus 20 square is 400.
80,
Multiplied by 0.2, 80.
80.
That's 160. Yes, okay. Talk to me. What's your question?
I am a bit lost from, I got up to expected return from the probability of the Y. I lost it. I don't know how it got that far.
The probability of Y.
Yes, after this expected return, I understood how we got the expected return, which is 0.20 times 50 will give us all those Y. After then, I don't know how we got the other figures.
Okay. So what we did, this is the formula we are working towards. We want to determine the variance. So, and to get the variance, this is the formula. This is the formula for variance. So in this case, Y minus X bar, this 30 that you have here is your Y bar. So Y is your return. So 50 minus 30 will give us 20. 30 minus 30 will give us 0. 10 minus 30 will give us minus 20. So you are just following the formula you have in each column. You are following the formula, the letters that you have in each column. All right. So take into consideration the Y and then the Y bar. So I believe when you settle down, you understand how we got those numbers. We did the same thing under risk and uncertainty. It's the same, right? So like I said, 50 minus 30 will give us 20. 20 square, when you take Y minus Y bar raised to a square, we give you 400. At least 20 square will give you 400. P multiplied by Y minus Y bar square. Y minus Y bar square is 400. 20% of 400 will give us 80. That's how we got the numbers. I believe that is clear. Okay. Okay. Are you clear
Yes,
or you still have concern?
it's okay. Thank you, sir.
It's all right. So after this, of course, we then calculate standard deviation for security Y. Standard deviation of Y is equal to square root of 160. So what's the square root of 160?
12.65.
12.65. Okay, 12.65. When you look at the return of security X, you will see that return of security X is 25. Return of security Y is 30. That means security Y has a higher return, right? When you look at the risk as measured by standard deviation of security X is 3.87, whereas the risk of security Y is 12.65, which means that the risk of security Y is higher than that of security X. Okay, so as a rational investor which do not like risk, or as a risk-averse investor may choose security X, while a risk-aggressive investor may decide to choose security Y with a higher risk and higher return. But that's not what the examiner is asking you. Now, to answer the question, I will then come here. We have not done, we have only calculated expected return of each security Y, X, and Y. We have not calculated all this one, they are more like a working, all right? Then to calculate the return of the portfolio, I will say return of portfolio return, RP. So to calculate the return of the portfolio, RP will be equal to the proportion invested on security X multiplied by the expected return on security X plus proportion invested on security Y multiplied by expected return on security Y. Therefore, return of the portfolio equal to, according to the question, you are told that 60% is invested on security X and 40% on security Y. So if that is the case, the proportion of X is 60, which is 0.60, multiplied by expected return on security X, which is 25,
5.
plus the proportion of security Y is 40%,
40.
multiplied by expected return on security
30.
Y, which is 30. So my return of the portfolio will then be equal to 60% of 25.
15.
15 plus 40% of 30 will give us 12.
12.
Therefore,
That's
return of the
27.
portfolio is equal to 27.
7.
So this is one way of calculating the return of portfolio. I will show you another method of calculating return of portfolio, but for now, let's calculate for the risk of the portfolio. We have calculated the risk of individual security using the standard deviation. So this one are more like a working. We are going to tabulate everything later on, right? So let's calculate the risk of the portfolio. All right. So again, I can decide to use formula, or I use tabular method. Whichever method that I use, I will get the same answer. So we are going to demonstrate the two. Let's calculate the risk of the portfolio using the formula first. All right, Rosimon, you are the one asking me if examiner will, if you see Greek, you see Greek letters, you now begin to ask if examiner will give you this formula on the day of your exam. You better master it. It will not happen. All right. So the first letter here is the proportion invested on security X. You square it, multiply by the variance of security X plus proportion invested on security Y squared, then multiply by the variance of security Y plus 2 multiply by proportion invested on X, standard deviation of X, multiply by proportion invested on Y, standard deviation of security Y, or multiply by correlation coefficient between security X and Y. And I told you, right? Okay, before we go there, so you then put the figures. Let's put the figures. Now, we are investing 60% on security X. Pay attention. So 0.6 squared multiplied by the variance of security X. Based on our calculation, variance of security X is 15. Okay, here will be 15 plus we invested 40% on security Y. So you square it, then multiply by variance of security Y, which is 160, plus 2 multiplied by proportion invested on security X, which is 60%, multiplied by standard deviation of security X, 3.87, I think. Let me go and confirm first. I think this is 3.87. What's wrong with you? 3 points. Let me write it. Why are you misbehaving? $3.87. All right. Then multiply by 40% on Y, multiply by standard deviation of security Y, I think is 12 point something, 12.67, 3.87, 12.65. So multiply by 12.65. Then all multiply by correlation coefficient between X and Y. Pay attention. You know, I told you earlier today, where securities in the portfolio have different probabilities, it means that there's no relationship between them. You can see security X and Y have different probabilities. That means our R, which is correlation coefficient, will be equal to 0. Okay, the R will be equal to 0. So in this case, I would then say the risk of the portfolio, let me use calculator here, 0.6 square,
That's 0.36.
0.36 multiplied by 15. Multiply by 15, that's 5.4, right?
5.4, yes.
So here will be 5.4 plus 0.4 square
0.16.
0.1, everything multiplied by 160.
That's 25.6.
25.6. Then plus, 2 multiplied by all of this, it will give you 0. So this one will be equal to 0.
Everything will be
So
31.
So that will be square root of 31. What you get?
5.57.
5.557. So the risk of the portfolio is 5.57. So if I want to put this in all what examiner is asking us, we have achieved it. You are asked to calculate in A. We are asked to calculate expected return of individual security. We have done it. And then of the portfolio, we have done it. The risk of individual security as measured by standard deviation, we've calculated it. Then the risk of the portfolio, we've also calculated it. So we only have C left, but I don't want to go there yet. I don't want to go to C yet. Now, I'm using formula to achieve the risk of the portfolio and the return of the portfolio. What if I want to use tabular method? So to use the tabular method, let me show you what you need to do. Alternatively, if I want to use tabular method, we have security X and Y. So we need to redefine that. So we define our variable. You then say, let securities X and Y equal to, we can call it any letter. So let's give it letter A. Let security X and Y equal to A. Now, there are three different probability of security X and Y. So that means 3 multiplied by 3. So we are going to have 9 possible outcomes. In the question, we are given probability of security X is 0.3, 0.4, then 0.3. Probability of security Y is 0.2, 0.6, and then 0.2. That's 3 by 3. So that means we are going to have 9 possible outcomes. So if you now want to use tabular method to estimate the expected return and then the standard deviation of the portfolio. So in this case, you are going to have 9 possible outcomes. So what you are going to do is that you are going to keep the security of the return of one security, you keep it constant, and then you vary the return of other security. This is what I'm trying to say. So you come here, you can say possible outcomes, possible outcome. So you can have 1, 2, 3, 4, 5, 6, 7, 8, 9, because the probability of each of them are 3. So 3 multiplied by 3 is 9. If the probability of the first one is 2 and the probability of the second one is 3, that's 2 multiplied by 3, give you 6 possible outcomes. If the probability are 4 each, that means you are going to have 16 possible outcomes. But again, examiner cannot be giving you that kind of a stress. All right. So after this, we are going to do working. You create a column for working for returns. Then after that, whatever the answer you have, it will then be the return. Then after the return, you have probability. You have the combined probability. This will be combined return. Let me put it down. This will be for combined return. Then combined probability. So then our return in this case is A. So we then have A minus A bar, A minus A bar square, then probability of A minus A bar square. All right. So hopefully this space will be sufficient. This is A, this is P. Oh, I'm sorry. That's I've omitted one. I did not put expected value. I've omitted one. All right. Let me rewrite this. Combined return. Let me shift because of space. Denoted as A, then combined probability denoted as P, then expected return, which is P multiplied by A. Then we have A minus A bar, A minus A bar square. Then probability of A minus, sorry, I'm using X. Probability of A minus A bar square. Okay. So the reason I have to show you this because you never can tell. At times, examiner may want you to use tabular method to determine the portfolio, the risk of the portfolio and the return of the portfolio. So when this happens, you cannot use formula. You have to use the tabular method. So you have to know it. All right. Okay, let me finish the table. All right. That's it. So this will be the variance. This is the return of the portfolio. Return of the portfolio, which is A bar. All right. Now pay attention to what I'm about to say. Let me bring it out so that it will be clearer to you when we are doing it. Now, for security X and Y, probability of security X is 0.3, is it 0.3? Yes. 0.4, then 0.3, right? Probability of security Y is 0.2, 0.6, 0.2. This is probability, then this is return for X and Y. So give me the return of security X.
X 30,
Uh-huh.
20, 25, 20. 30, 25, 20.
Okay, for Y?
50, 30, 10.
Okay, so this will help us. Now, pay attention. When you are constructing, when you want to determine the portfolio return and then the standard deviation of the portfolio using the tabular method, you are supposed to keep the return of one security constant and you vary the return of the other security. Now, this is what you are going to do. Let's keep the return of security X constant and vary the return of security Y. Whichever way you want to do, you are going to get the same answer. So this is what I'm saying. The proportion invested on security X is 60%. Therefore, I will say 0.60 multiplied by the return of security X. The first return is 30. So we are going to keep that 30 constant. Then plus, open a bracket. We are investing 40% on security Y. Multiplied by the return of security Y. The first one is 50. Okay. Again, 0.60 multiplied by 30. That 30 will remain constant until I finish the first option. Plus 0.4. The second return for security Y is 30. Okay. Here will be 30. Then the next one, 0.60 multiplied by 30. That 30 will remain constant. Multiply by 0.40, multiply by 10. I believe you are following. So we are done with the first option. We move to the next option. You know, the probability, the return of security X, the first one is 30. That 30 will remain constant then you vary the return of the other, sorry, yes, if you vary the return of the other security, that's why you are seeing 50, 30, 10. But 30, 30, 30 is constant. So you then move to the next one. The next return for security X is 25. So here will be equal to 0.60 multiplied by 25. That 25 will remain constant for the next three periods. So plus 0.40 multiplied by 50. Here will be 0.60 multiplied by 25 plus 0.40 multiplied by 30. 0.60 multiplied by 25 plus 0.40 multiplied by 10. We are done with the second option. So we move to the last one. 0.60 multiplied by, is it 10 or 15? 20. The third return for X is 20. So plus 0.40 multiplied by 50, 0.60 multiplied by 20, plus 0.40 multiplied by 30, 0.60 multiplied by 20, plus 0.40 multiplied by 10. So let's determine the value. Yeah, bring out your calculator and be giving me the numbers quickly. Let's start from the first one. You open a bracket, okay? Open a 0.6 multiplied by 30. Close the
That's
bracket. Plus, open a bracket, 0.4 multiplied by 50. Close the bracket. Equal, that's 38. Did you get
yes.
38?
Yes.
So the next one, what do you have?
30.
30, okay. The next one,
20. 22.
22. Next,
35.
35.
Yes.
Okay. Next one.
Ah, that's where I stop.
Oh, okay. Uh, 0.6 multiplied by 25 plus 12. 0.6 multiplied by 25 equal. That's 27. That should be 27.
The one with 10 is 19.
Pardon?
Number 6 is 19.
19. Okay. Which is 12 plus, sorry, 15 plus 4. Yeah. Then 12 plus 20. That should be 32, all right?
Yes, sir.
32. Then 12 plus 12, 24.
4.
Then 12 plus 4,
That's
16.
16.
16. So now we have the return. So now the same way you combine your return is the same way you are going to combine the same way you calculated your return here. How you join your return together is the same way you are going to get your combined probability. So in the first one, pay attention, please. The first return of X is 30. So probability of that 30 is 0.3. You then say 0.3, that means use 0.3 multiplied by the probability of 50 for Y. Probability of 50 for Y is 20. So multiply by 0.2. That will give us 0.06. Here is 0.06. So the probability of the second return for X is still the same thing as 0.3. Probability of 30 return for Y is 0.6. Therefore, I would then say 0.3 multiplied by 0.6. That should give a 0.3 multiplied by 0.6. That should give a 0.18. 0.6. That's 0.18. 0.18. Again, the probability for the third line the probability of that 30 still remain as 0.3. So I will say 0.3, probability of 0.3 multiplied by probability of 10 return for y, which is a 0.2 multiplied by 0.2 equal to 0.06. Yes, okay, what's your question, please?
I just wanted to say, is it possible for us to put it down in writing?
You can do your working. You can do the working. You can do the working, you get the same answer. So what is important is that you are picking the probability of each return that you have combined. So that's what you are supposed to do. The same way you have combined the return to get 38, 30, 22. So the probability that is attached to each return, you multiply them together. That's all. So the fourth one, probability of that 25 for x is 0.4. Therefore, I will say 0.4 multiplied by the probability of 50 for y is 0.2 multiplied by 0.2 equal, that's 0.08. 0.08. All right. Then the probability of 25 for x is still the same thing as 0.4. So here is 0.4 multiplied by probability of 30 for y. Probability of 30 for y is 0.6 multiplied by 0.6 equal, that's 0.24. Here is 0.24. Then probability of that 0.25 is still the same as a 0.4 multiplied by probability of 10, return 10, which is a 0.2. That's 0.08. Here is 0.08. Then the last one, probability of return 20 for x is 0.3. Probability of return 50 for y is a 0.2. So 0.3 multiplied by 0.2, that should give us 0.06. Then probability of return 20, which is point of return 30, which is 0.6, that's 0.18. 0.18. Then probability of 0.3 multiplied by probability of 0.2, that will give us 0.06. Okay, yeah. Now that we have the probability and the return, so we can then calculate expected return. So this will then be equal to 38 multiplied by 0.06 equal, that's
2.28.
2.28. Here will be 2.28. All right. Then the next one will be 30
30 points.
multiplied by 0.18. What do you have?
5.4.
5.4.
4.
Okay. The next one, 22 multiplied by 0.6, 0.06.
1.32.
1.3.
1.32. Then the next one, 35 multiplied by 0.08.
2.8.
2.8.
2.8. Then 27 multiplied by 0.24.
6.48.
6.48. 19 multiplied by 0.08.
1.52.
1.52.
1.52. Then 32 multiplied by 0.06.
1.92.
1.92. 24 multiplied by 0.18.
4.32.
4.32. And the last one, 16 multiplied by 0.06.
0.96.
0.92.
6.
6, okay? So let's add up everything. Add it up. What you get? 2.28 plus 5.4 plus 1.32 plus 2.8 plus 6.48 plus 1.52 plus 1.92 plus 4.32 and plus 0.96. What you get?
So I take it, okay.
27.
27. Okay, 27. When you look at this, you need to compare this return of the portfolio of 27 using the tabular method. You compare with what we got when we use the formula method. It's the same thing, right? So again, using the tabular method to calculate the standard deviation of the portfolio. So A minus A bar. So 38 minus 27 will give us 11, right? So 11 square. 11 square will give us 130, is it 132 or 121, whatever? Let me, 38 minus 11 minus 27, that's 11, correct. So 11 square
121.
will give us 121. So 121 multiplied by probability of 0.06.
Probability of what?
0.06.
7.26.
7.26.
26.
No rounding. You have to write it out in full. No rounding.
It doesn't have any other figure.
Oh, okay then.
Please, somebody should confirm.
Then the next one is 30. 30 minus 27 equal to 3. 3 square will give us 9, right?
Yes.
3 square will
9,
give us 9. Multiply by probability of 0.18.
1.62.
1.62. And the next one, 22 minus 27 will give us minus 5. Minus 5 squared is 25. 25 multiplied by probability of 0.06.
Still minus 1.5.
Pardon?
1.5.
1.5. Okay, 1.5, that is 0.06. Let me see.
Yeah.
0.06 multiplied by 25. That's 1.5, correct. Then 35 minus 27, that will give us 8. 8 squared will give us 64. 64 multiplied by 0.08. 64 multiplied by 0.08. That's
5.12.
5.12. The next one, 27 minus 27, 0. 19 minus 27 will give us minus 8. Minus 8 squared will give us 64. 64 multiplied by 0.08 will give us 5.12. Next one, 32 minus 27 will give us 5. 5 squared will give us 25. 25 multiplied by probability of 0.06. That will give us 1.5. Next, 24 minus 27 will give us minus 3. Minus 3 squared will give us 9. 9 multiplied by probability of 0.18 will give us 1.62. Then the last one, 16 minus 27, that's minus 11. Minus 11 squared is 121. 121 multiplied by 0.06 will give us 7.26. You then add up everything. What you get? Add up the variance.
At a one.
31. The variance of the portfolio is 31. So to now get the risk of the portfolio, you then find the square root of the variance of 31. So this will give you 5.57,
5.57.
which is consistent with what we got when we use the formula. So whether you use formula or use the tabular method, you are supposed to get the same answer. This table, at times, like I mentioned, examiner can ask you to use the tabular method. All right. So if you don't know it, there's no way you'll be able to achieve it. And that's why you don't run away from it. Just take your time to master it. It's not difficult. It's not difficult. Yes, Rose, talk to me quickly.
Sir, please, can you just one more time? How you got that 0.06? I didn't get it.
To get the probability, look at the heading. You are combining probability the same way you combine return to get 38, 30, 22, and all of that. It's the same way you are going to combine your probability. What you are doing is that you are going to pick the return for this first line. The return of x is 30. What is the probability of that 30, which is 0.3? The return of y in the first line is 50. The probability of that 50 is 0.2. Therefore, 0.3 multiplied by 0.2 will give you 0.6. The second line, the return is still 30. Probability of 30 is 0.3. Then for y, the return is 30. The probability of the 30 is 0.6. Therefore, 0.3 multiplied by 0.6 will give you 0.18. That's how you are going to do, that's how you are going to determine the probability. Okay? Okay, let me just put it as an example. Let me do line for you as an example. So the first line, the first possible outcome, the probability, this is the probability, combined probability. Combined probability. So the first one, the first possible outcome, the return of x is 30. Probability of that 30 is 0.30. Multiplied by probability of y, the return of y is 50, and probability of that 50 is 0.2. So this gave us 0.6, 0.06. Again, the second possible outcome is still the same thing because return of x is still the same thing as 30, right? Then the return of y is 30. Probability of that y of 30 is 0.6. So here will be 0.3 multiplied by 0. What did I say? 0.6. So this will give you 0.18. For the third possible outcome, the return of x still remains the same thing as 30, and probability of that 30 is 0.3. The return of y is 10. Probability of 10 is 0.2. So this will give us 0.06. So that's how we generated the numbers. So you can follow through. All right. So that answers the question. Now, let me just spend like 5 minutes to explain the second illustrations to you so that you understand. Let me use Golden Book to do this. Somebody sent me the chat. Please, how did...
I'm
Oh,
the one.
okay. It's all right. So let me stop sharing this. I believe by the time you listen to the video, you understand better. Some of you have disappeared. No worries. Let me just share. Let me open the Golden Book. Let's see.
Sorry, sir. Does that mean with this table, we have done the A and B part of that illustration.
Yes, we have answered the question. Only C we have left. And in the C part of the question, examiner is asking you is asking the objective of portfolio diversification. The essence of portfolio diversification is to minimize portfolio risk by investing in securities that are negatively correlated or securities with no correlations. That answers the question. All right, that answers the question. I just want to let me use Golden Book to show you something. Take your time to review your material on portfolio, especially if you have the Golden Book. Portfolio is a very interesting topic in financial management or corporate finance. It's a very interesting one. Let me see. Let me see. I think this is the question. Yeah. So, yeah, this is the question. So in the C parts, like I said, the objective for portfolio diversification is to minimize portfolio risk to avoid a disastrous financial outcome by investing in securities that are negatively correlated or securities with no correlation. So according to the question again, examiner is asking, outline the objective of portfolio and explain in general terms why the risk on individual security may differ from that of the security from that of the portfolio as a whole. So to answer that, the risk of individual security may differ from that of the portfolio because the risk of individual security is specific, whereas the portfolio risk account for total risk, that is, both systematic and unsystematic risk. The modern portfolio theory is premised on the assumption that a rational investor do not like risk, which means giving an investor a high level of risk, he or she will expect the same level of return. All right. As shown in the calculation above, security A has a lower risk and return relative to security Y with a higher risk and return. The risk associated with security Y is higher than that of security X. Okay. However, the benefit of diversification has reduced the risk of the portfolio as a whole. You know, the risk of the portfolio now is 5.57, whereas the risk of individual security A has a risk of security X has a risk of a 3.87, security Y has a risk of 12.65, but because of portfolio diversification, the risk has reduced to 5.57. So that's what we are saying here. That's essence of diversification. So that answers number B. Okay, that answers number B. Now, okay, let's do it this way. In our next class, by the grace of God, I will solve one more illustration. I just want to, I don't want to stop this topic now. We are going to have one additional illustration in our next class, whereby in the question examiner will not give to you the return in percentage. It will be given to you in Naira. If you have such a situation, how do you then compute your portfolio return, portfolio risk, and the likes? So we are going to do it in our next class. Again, I want to encourage you, go ahead and study. Go and study capital asset pricing model, because once we meet again next weekend, on Saturday, by the grace of God, we are going to do this illustration number 3. We are going to do this illustration number 3, whereby we are given return in Naira, which of course you don't use Naira. You have to convert it to percentage. So in such a circumstance, how do you do it? That's what we are going to do in our next class. So please don't close your book until we meet again on Saturday. Please ensure you go through what we have done today so that you don't forget all your learning, because once you close your book, your learning will disappear. It will also close you, and that's you have to practice it. Ensure you get all memorized, master the formats and the formulas I've given to you today. Master the formulas. All these algebraic formulas are given to you. Make sure you master them. Once you master it, then close your book, write it down on your own so that you get it. Once you understand it, then going forward, it will not be difficult for you. That's the way to learn. Please don't close your book. Don't close your book till we meet again next weekend. Please don't do that. Your exam remain 41 days now. Let's say roughly 40 days. So there's no time for you to waste at all. Whatever you are learning now, you have to make sure you understand it so that you are not going back to it again. Once you understand it once and for all, don't go back to it again. But if you are having average, if you have just average knowledge of the topic, then that means you are going to be struggling. You'll be going back and forth. But once you understand it deeply, then going forward, you don't need to come back to it again. Your focus should be on those ones you have learned in the past, about 3 months ago, or anyone that you have not learned at all. So that should be those should be your focus. So please, time is going. You don't have time to waste at all. Please start reading, double your effort, right? So that will be that for today. And then in our next class, by the grace of God, like I said, we are going to have one more illustration under this. Then thereafter, we then move to capital assets pricing model. So do your best to ensure you go and study capital asset pricing model. Is a very interesting topic in financial management, which is capital asset pricing model is a continuation. It's a continuation of portfolio theory. All right. So like I was telling you the other time, you go and form a note. You need to form a note on the capital market line. So you form a note on capital market. You read it. Once you understand it, then you form a note on it. You summarize it. So examiner can ask you. You also form a note on the capital allocation line. Okay, form a note on capital allocation line, security market line, indifference curve. Okay, form a note on indifference curve. All right, so that's an assignment for you. All right, so thank you. Let me know if you have any question for me before we close the class. Any question? All right, so let me see. Ada is still on. Osage, Agnes Osage, David, Esther, Ruth, Hamid, Joseph, Ogechi, Rose, every other one. So majority of you have disappeared, you can imagine, including Angela. It's okay, no worry. It's understandable. All right, thank you guys. I will see you on weekend by the grace of God. Good night, everyone.
Good night, sir.
Good night, sir.
Yeah,
Nice.
good night.
Thank you very much.
Night,
Good night.
sir.
Good night.
So please, are we getting the notes now so that we can
No
fix it?
worries. I will share.
Thank you, sir.
You're welcome.